So talk of West Coast IPOs usually means hype about companies like Facebook. There are some more staid companies as well. We have a new one, Jeff, with a more staid result as well. Tell us what's
Oaktree
going on
Capital,
here.
which is a private equity firm mainly focused on investing in debt, has $75 billion of assets under management, just went public. Not such a great hit. The shares were, they sold
priced at the bottom end of the range.
Priced
right?
the bottom, sold less than they wanted to. Then the shares came down even further when they opened.
Right.
So not a great reception.
But people are holding Howard Marks, who's the founder and the sort of, the leading light of the place. They're holding him to his word, aren't they? I mean, he's always said, our business is about generating returns for our investors. It's not about maximizing profits for the general partners.
He's done the rare thing of saying, look, I can't invest all this money I've got profitably, so I'm going to give it back.
He's taken a distinct approach in this space, saying that bigger isn't always better, and that flies in the face of everything that's happened since Blackstone really went public in 2007. All the firms that have come out to market, KKR and Apollo and Carlyle, presumably next week, have talked about growing assets under management and have done it, and have also really, been focused on things like management fees and diversification and spreading.
And the market is, of course, the market's rewarded them with, in one respect, it looks at things like management fees. Now, management fees are just a function of gathering assets, not necessarily the return, which would, of course, be the carried interest.
And this is actually something that's really Blackstone's fault. When they went public in 2007 at the top of the market, things started to tank, and they came down.
Yet again for another ill in the capital market.
Well, they did it because the carry went down, the profits went down, the shares went down to a couple bucks, and so what they did was they turned around and tried to sell this story to the market. It's like, hey, wait a minute. We may not be generating a lot of profit. Our assets might, because of the way the markets are, but we have a lot of steady management fees. That changed the way the market looked at
the whole conflict between investors in the funds they manage and investments in the manager that manages the funds, right? Which is the shares we're talking about. How's Howard Marks going to sort of juggle that now?
Well, he's been very transparent and open, with shareholders. I think it's one of the top risk factors in the prospectus. Certainly, when I've spoken to him, and he's made it very clear that, that generating returns for his funds and investors in his funds comes first before anything else.
Of course,
that's why he's sent money back. He's clipped funds, capped funds.
The problem in his logic is that it hasn't borne out this year, or when investors are looking at the now, because the distributable earnings went down this year as opposed to Carlyle, where they went up. So it's not always going to be the case, but his story was sort of a hard one to sell, I guess, because he didn't have either one. He didn't have assets under management growing; they actually shrank last year, and distributable earnings also fell. So, the market clearly kind of looked at it and said, "This isn't maybe for us." And
so they'll go for Carlyle next week.
Maybe.
Yeah. So we have Carlyle next week. We'll be keeping an eye on that one. We'll keep an eye on Oaktree too, and we'll have more breaking views tomorrow.